The overwhelming factor that determines the interest rate on your mortgage is, of course, the Bank of England base rate. Now, this is set by the Bank of England, and it pretty much determines the lowest rate at which financial institutions will lend money to customers. Most mortgages are linked to the base rate in some way. It's a huge influence on standard variable rate mortgages, on tracker mortgages, but if you're on a fixed rate mortgage, of course, then you'll be priced at a rate that the mortgage provider thought was a good deal at the time, and it won't change in most cases, even when the base rate changes. However, if you're on a tracker rate, that of course will follow the base rate up and down. If you're on the mortgage provider's standard variable rate, that will also follow the Bank of England base rate to some extent. So when you're thinking about mortgages, it's really important to think, if you're fixing a mortgage, then that's one price. If you're on a tracker or a variable rate mortgage, that really is going to follow the Bank of England base rate, and you'll really want to know if that's likely to be heading up or down anytime soon. Lenders have always set their variable rates according to their business circumstances at the time. So if they need to make a lot of profit per borrower, the rates might be higher. If they don't need to actually make any money from mortgages, they might price rates high as well to sort of prevent people from taking those mortgages out in the first place. So there's lots of factors. Smaller institutions tend to have higher variable rates because they need to balance the needs of their savers versus their mortgage borrowers to a greater extent than larger firms. This is the big question: when will rates rise? Now, a lot of economists think it will happen very early in 2015. Some people think it might happen after the general election, which will happen in May. When it does happen, a rise in the base rate from 0.5% to 1% will add about £30 to £40 a month to the average mortgage of about £200,000 on that sort of variable rate basis. So when they do rise, some families might start to feel the pinch. I mean, that's a 0.5 percentage point rise if the Bank of England base rate rises to 1.5 to 2% to 2.5. You're quickly in territory of sort of £150, £200 a month more in mortgage repayments. So you'll need to bear that in mind when you're perhaps remortgaging or looking to buy a house in the near future. If you have a fixed rate mortgage, our advice is not to panic at all. It's likely that you'll be fixed for the foreseeable future. You might be on a 2-year fix, a 3-year fix, a 4-year fix, and you know that if the Bank of England base rate rises, your repayments will stay the same. People with tracker rate mortgages have done pretty well in the last few years. They probably tracked the base rate down a few years ago to 0.5, and they've been on really nice repayments ever since. The flip side of that, of course, is that when the base rate rises, their repayments will go up, and if the base rate keeps on rising, their repayments will keep on rising. So we'd recommend that people perhaps look at taking out a fixed rate mortgage if they're on a tracker, because it will give them peace of mind. And then there's people with variable rate mortgages. Now, it's very hard to tell what's going to happen with variable rate mortgages, because historically the gap between providers' variable rates and the Bank of England base rate has been quite small, but at the moment it's quite large because the base rate is so small at 0.5%. Now, when base rate rises, it'll be really interesting to see what happens to variable rates, because they should actually rise at the same rate as well, but that would see variable rates going up to sort of 6, 7, 8, 9% fairly quickly, and I don't think anyone wants that. So we kind of think that variable rates will just edge up slightly, but no one knows. So if you're on a variable rate mortgage, I would probably have a look around, see what your terms and conditions are, perhaps look at exit penalties, and perhaps have a think about a fixed rate or a different type of mortgage, because it's simply no one knows what's going to happen with variable rates. So I'd be possibly a little bit more worried than I was on a different type of mortgage.